One way to manage interest rate risk is with an interest rate swap. So here's how a typical swap works. You've got two parties, A and B, and they're agreeing to exchange cash flows at some point in the future, whereas A is agreeing to pay cash flows that are based on a fixed rate of interest, and B is agreeing to pay cash flows that are based on a floating rate of interest. Usually both parties' cash flows are in the same currency, and they have the same notional amount. Now the notional amount, so let's just say that that's 5 million euros. Okay, so we got 5 million euros here. That's the amount on which the interest is calculated. So if A is paying a fixed rate of, let's say, 4%, okay, then it would be 4% times 5 million euros. Okay, and then B, whatever they're paying, would be their floating rate times the 5 million euros. So it'd be the same notional amount. Okay, so I'll show you that with our example in a moment. Now, the floating rate is going to be based on an index, something like LIBOR, okay? So it's going to float, it's going to change every period, okay? It could change, let's say it's semi-annual or annual, whatever it happens to be the terms of this swap agreement. Now, the fixed rate is going to be set so that the value of this swap contract is 0 upon the inception of the swap contract. So neither party is going to need to pay the other one a premium to enter into this agreement. Now, the fixed rate is also known as the swap rate, okay? And the swap rate is set. So, and here's how we get, if you're wondering how the value of the swap contract is 0 upon inception, the swap rate is set such that this equation is going to hold. We're going to have the value of the fixed rate instrument upon inception of the swap contract is going to be equal to the value of the floating rate instrument, okay? So both parties enter into this. Neither of them has to pay a premium to enter into the swap agreement. Now, if you're wondering, let's say you had a grocery store that wanted to engage in an interest rate swap, who would they engage in the swap with? Like, who are the market makers? Well, commercial banks and investment banks heavily engage in interest rate swaps, and they can serve as the fixed payer or the floating payer in a swap. And this is heavily used, obviously, in asset liability management for banks because they are heavily exposed to interest rate risk. Okay, so let's do an example. I think this will make it a little bit easier to understand. So let's say that you've got a 2-year interest rate swap and the fixed rate is going to be 1.5%. So that's an annual rate, 1.5%. Okay, so that is the swap rate. Okay, now the floating rate is going to change. Okay, so it's initially going to be 1.3%. Okay, but it's going to be tied to an index. Let's not think about what index it is. Let's just keep this simple. It resets semi-annually. So every 6 months, it's going to change. It's not necessarily going to be 1.3% every single period. Okay, and then the notional amount, we're going to have 1 million euros. Okay, that's the same notional amount for each party in this transaction. Now, in terms of the day count convention, we're going to use the actual amount of days in the period divided by 365 days, okay, for the year. So don't worry as much about that, but if you're really into banking, you might have seen other day count conventions, okay? So here we've got January 1st, 2021, so let's say that is the inception date of the swap. So the first pay period, or the first payment, is going to be on July 1st, 2021. Okay, so we've got 182 days for purposes of calculating interest. Okay, so we're going to have to calculate. So we've got the fixed rate is always going to be the same for the fixed rate payer. Okay, the floating rate is initially 1.3%, but then it's going to change every 6 months. Okay, because it's tied to an index. Now let me show you how these calculations are made, because I got a lot of numbers here. Okay, so the fixed payment that is due, okay, on July 1st, 2021, by the fixed payer in this swap agreement is going to be 1.5%. Here, let me write this out for you. So 1.5% times 182 divided by 365. If you're wondering why that, remember, 1.5% is an annual interest rate, but this only applies for 182 out of 365 days. This is basically half the year. Okay, half the year. So we can't just multiply by 1.5% without accounting for this. Then we multiply by the notional amount, which was 1 million euros. Okay, so the annual rate, this is for the fixed payer, okay, to get this number right here. So 1.5% times the amount of days, okay, in the period, 182, divided by the days in the year, 365, times the notional amount. So that is going to give you 7,479 4.45 euros. Okay, so this is the amount due that the fixed payer is owes to the floating payer. Okay, so if you're the fixed payer in this agreement, this is the payment you need to make. Now, the floating payment is calculated similarly. So we got 1.3%. So instead of the 1.5, it'd be everything else would be the same, but you just have 1.3%. Same notional amount, same day count, and so forth. Okay, so that would give you this right here, 6,482.19 euros. Now, here's the catch. This is what the fixed payer owes. This is what the floating payer owes. But they don't send each other, like the fixed payer doesn't pay 7,479 euros to the floating payer, and then the floating payer, they just exchange the difference. Okay, so the difference in this case, this is higher than this. So the fixed payer is the one that has, on a net basis, has to pay. So the fixed payer is going to end up paying the difference, 997.26 euros, to the floating payer, and the floating payer pays nothing. Okay, so just remember, it's just the difference between the two changes hands. Okay, there's no need for each of them write a check to each other. Okay, now December 31st, you see now there's 183 days in that period. So you'd have to calculate this right here, 7,520.55 euros, the payment by the fixed payer. It'd be 1.5% times 183 divided by 365 times 1 million euros, which is our notional amount. Okay, that was in the given information. And that would be 7,520.55 euros. So this is where these numbers are coming from. And again, this number is bigger than this number, so we're going to have a net payment by the fixed payer on December 31st, 2021. Okay, I hope you're seeing how this works. Now, the floating rate continues to change, right? It's different every time. And on the last pay period, we have actually the floating rate exceeds the fixed rate. So at that point, now the floating payment is higher than the fixed payment. So the fixed payer is actually going to receive a payment. Okay, they're going to receive 150.41 euros here. That's why I've got it in parentheses to indicate that they're not paying it out, they're receiving it. So when the floating rate is higher than the fixed rate, the fixed rate payer is actually, they're getting money instead of paying it out.